So we move to the last paper of this session, Martina Yasova, Glossy Green Banks.
Perfect. So thank you very much for including our paper in the program of the conference. This is a joint work with Maria Assunta Gianetti, Maria Lomiotti, and Caterina Mendicino. And as Caterina is with the ECB, the usual disclaimer applies. These are our views and not necessarily the views of the ECB or the Eurosystem. All right. So many banks these days celebrate themselves as the pioneers in embracing and engaging in environmentally themed activities. And following the global trend of rising voluntary disclosures, banks are joining this pattern, and they are increasingly emphasizing their environmental activities also in their disclosures and annual reports towards their investors. Now, the literature has generally showed that these types of disclosures tend to be associated with a number of benefits. For example, more loyal customer base, a higher ESG rating, or lower cost of capital. However, there is some skepticism, both by the policymakers as well as the market participants. And this skepticism is essentially asking whether these environmentally themed disclosures proposed by banks are actually credible, or whether they primarily just contain unsubstantiated claims where banks are selectively reporting on certain activities and trying to just symbolically comply with these new institutional roles. And so in this paper, we try to study this question in detail. And specifically, we ask, what is the relationship between the bank environmental disclosures and their actual bank lending activities? And the way we answer this question is in two steps. So in the first step, we use the annual reports and sustainability reports of a large set of European banks to analyze their environmental disclosures. And in the second step, we link these disclosures to bank lending to firms. And specifically, we look into a couple of heterogeneities. We look into differences in lending to firms in brown versus green industries, to firms specifically based on their firm level emissions, so to borrowers who actually have higher level of greenhouse gas emissions. And then finally, we use the information of borrowers that describe their businesses as green based on the EU taxonomy. So the main finding of the paper are as follows. So on the first part, we showed that the environmental disclosures of European banks are generally positively associated with the higher environmental risk of the country where the bank is localized, a higher social activism in that country, a stronger regulation, as well as higher bank ESG rating. At the same time, we show that banks that have higher level of these environmental disclosures actually are more involved in the issuance of green bonds. Now, the key focus of our paper, however, is on lending, and we find a couple of things. The first thing we find is that banks that talk more about the environment actually end up lending more to high emission borrowers rather than the other way around. Interestingly, we don't find any evidence that these loans would be funding the transition of these firms towards greener technologies. And finally, we show that banks that are engaged in these activities the most tend to be lowly capitalized, and specifically they lend to the weakest borrowers in these brown industries. So overall, in the paper, we document this disconnect as to what banks say and what banks do, and we show that banks tend to overemphasize their climate goals and then continue the relationship with their polluting borrowers. So, a few words about the data and methodology. So on the data side, the paper makes use of the granular loan level credit registry, which is the ANA credit. Many of you are probably familiar with the data. So it's the harmonized loan level data of all Eurozone commercial loans outstanding. We're going to focus on information on loan size, interest, and maturity. And one most important thing that I'd like to emphasize here is that unlike bond issuance or syndicated lending, this information is generally confidential. So market participants, investors don't really know what's in the loan book of the banks. So it's kind of a hidden part of the bank assets. And we're going to use this information for the newly issued loans for the period of 2014 to 2020, which is going to give us a sample of roughly 553 banks and bank subsidiaries across Europe. Now, as I mentioned, I will focus on a lending to green versus brown firms or brown industries, and we're going to do it in two steps. In the first set of results that I'm going to present, I'm going to focus on the industry level heterogeneity, which is going to come from Eurostat. And we're going to use the greenhouse gas emission data by the country, NACE to industry level and year. And this is going to be standardized by the industry value added. And then for the subset of these firms, I'm going to have firm level emission data, which are coming from the Urgentem. And we're going to use a firm level scope 1 and scope 2 emission intensities. And then finally, we're just complement this with regular data on firms and banks. All right. So the first step that I want to talk a little bit more about are the environmental disclosures. So if you were to write a paper like this in the US, it would be much more trivial because you could go to Edgar, download all of the annual reports at the same spot and, kind of process the information. In Europe, we have to visit each and every website of our banks, manually download this information, hope that it's published in English, and try to make sense of it. And this is going to give us a sample of roughly 1,400 documents that are going to contain, a bunch of information. Approximately half of it are coming from annual reports, and the second half is a range of reports, whether it's sustainability, integrated reporting, non-financial reports, and so on. So we start reading this. After approximately 50 of these reports, we start building our dictionary. So we start with this because, banks can be talking about an environment maybe differently than we know how non-financial companies talk about environment. So we start building out our dictionary by reading these annual reports and other statements. And then we complement it with additional topics that are either coming from the rep risk or the SASB. So this is going to give us a dictionary of words and bigrams that are related to topics such as energy use, emissions, biodiversity, or activities are commonly attributable to affect pollution. So our key measure of environmental disclosure is going to be the ratio of words that are these environmental keywords as a share of total number of words in the statement, excluding the stop words. So before I jump into the loan level analysis, let me show you some validation. So I know that this table is a little bit overwhelming, but I'm going to quickly guide you through it. In the column 1, what you can see is that the environmental disclosures tend to be correlated with the activism of that specific country. So meaning that the inhabitants in that country are more likely to, join the protest or, sign a petition if they learn about a company, violating certain environmental standards. We also see that there is a higher environmental risk of that specific country. Secondly, we see that environmental disclosures go hand in hand with other reporting, such as GRI standards or integrated reporting. I'm going to come back more to the bank characteristics a little bit later on. What you can see next is that indeed, also in case of banks, those that report more on environment tend to benefit from higher environmental ratings. And it doesn't really matter whether you use the information from MSCI, Bloomberg, Sustainalytics. And then finally, we see that banks that talk a lot about environment also tend to be more active in the issuance of green bonds. However, the main point of our paper is to look into the impact on lending. So before I jump into the loan level evidence, let me show you some bin scatter plot. On the x-axis, you see the share of the loans that are brown, going to brown industry. So this is the brown exposure of a bank. And on the y-axis, you see these environmental disclosures. And surprisingly, what you see here is there's a positive relationship. So there seems to be some disconnect, that banks that talk more about environment actually end up lending more to these brown sectors. So what we're going to do next is that we're going to examine this question more formally. And we're going to run the following set of regressions. I'm going to start by looking into, on the left-hand side, the log amount of credit that a bank B grants to firm F in year T. And this firm is going to be located in industry I in country C. My key coefficient of interest is the one highlighted in orange, and it's an interaction coefficient as to whether the industry is brown and an interaction with the environmental reporter. So the industry here is denoted as brown if the greenhouse gas emission of this specific industry in that country in that year ranks in the top quintile of our entire distribution. And the higher environmental reporter is a dummy that takes a value of 1 if the bank is, in terms of their disclosure, again in the top quintile. We present a bunch of robustness in the paper using continuous measures, and I'm going to talk more about firm level emissions later on. Importantly, we control for a couple of important things. Specifically, in order to control for the demand for credit, we introduce the fixed effects in this specification. We either start with the industry country time fixed effects, or then we move to a more standard Kwadjamian style fixed effect. So it's the firm time. So we observe the lending of the same polluting firm receiving credit from 2 different banks. One of them ends up talking a lot about the environment, the other does not. Furthermore, we control for bank characteristics either with the combination of bank fixed effects and additional time-varying controls, or with the time-varying bank fixed effects. So if these banks that actually talk a lot about the environment should be scaling away from lending to the brown industries, we should expect this coefficient beta 1 to be negative. So let's look into this. So as you can see, it's not negative, and in 2 out of these 3 specifications, even statistically significant. So these are the cases with the first set of fixed effects, and then when I fast forward to the Kwajamian style fixed effects, you see that this positive and statistically significant prevails. So there seems to be this disconnect of where banks are actually lending. And now you might think that maybe these high environmentally reporting banks are lending a lot to the very brown industries, but maybe they are trying to offset it by also lending a lot to a very green industries. So I'm going to replace the heterogeneity here and look into whether they're lending to the least greenhouse gas emitting industries. And you don't find really much here. There seems to be the same pattern of banks that talk about environment and those that don't. So these coefficients are not statistically significant. Now, we can repeat the exercise by actually really using the firm level greenhouse gas emissions. So the benefit of this is that we can move to a more granular measure, but the cost is obviously that we're losing a lot of firms for which we don't have reported firm level greenhouse gas emission intensities. Regardless, what you can see here is that the results are very robust. So they are positive and statistically significant when we control for the demand of credit with the interaction of industry, country, and time fixed effects. Now, as we move to the firm time fixed effects, the positive, the statistical power disappears, but the results still remain positive. And if anything, it shows us that there's no difference in lending coming from a bank that talks a lot about environment and the bank that doesn't seem to pay so much attention to these environmentally themed topics. So in other words, there seems to be this disconnect into what banks say and what banks do on the intensive margin. Now, until now, I presented the results using the granting of all kinds of new loans. Let's shift gears and focus on the establishment of the new relationship between a bank and a new firm. And what we can see here is that there is a silver lining, at least in 2 out of the 5 specifications, that suggests that high environmental reporters at least try to reduce new lending exposure to brown industries. However, when we shift attention to the termination of the relationship, we once again see that these high environmental reporters are reluctant to terminate their relationship with brown industries. So overall, again, there seems to be this disconnect between the environmental statements and the actual bank loan book. So the big question is why? And in the paper, we explore a couple of channels. The first channel you might think about is that this doesn't necessarily need to mean greenwashing, because what this can be is that the banks are actually funding the transition of these brown industries towards more carbon neutral. So in a sense, this can be associated with a bunch of benefits still. So in order to test this really carefully, in an ideal experiment, you would want to have the greenhouse gas emission of these firms over a very long time period and like to see whether these emissions are going down. So we try this for our limited period. We don't find much, but again, this could be driven by simply the fact that we are observing 6 years of data. So in response to that, we develop a couple of approaches that can help us tackle this question a little bit better. The first approach relies on the fact that funding transition is costly, and firms that tend to transit towards greener technologies might be more involved in high investment or research and development. So in other words, what we can do, we can compare the lending of the high environmental reporters to 2 firms in the same brown industry and see whether they're funding more the firm in the same brown industry that has more R&D or that has more investment. The second idea rests on the fact that it tends to be the new entrants that are the disruptors. So in other words, if you think about who is more likely to adopt greener technologies, who is going to innovate and disrupt these old brown technologies, this should be younger firms. So again, we can look into the cross-section of these firms and compare whether young firms receive more credit than brown firms in the same industry by these high environmental reporters. The third test that we're going to implement rests on the fact that firms can actually make science-based commitments to reduce their greenhouse gas emissions. So there's an SBTi data set that puts together science-based credible targets that the firms set for themselves into trying to get to a more carbon neutral ways. So again, we can compare 2 firms. One of them is an SBTi signatory, the other is not, and we can see whether there is some reallocation of credit. And finally, we use the capital IQ to present yet additional textual analysis where we compare the business description of the two firms. So you can imagine two firms in the textile industry. One is doing more of a fabric upcycling, the other one is more into fast fashion. And again, we can compare whether there is a disproportionate lending going towards a greener descriptive firm. So for today, I'm going to show you the results for the first three. And the results are here in this table. So in columns 1 to 4, you see the proxy for the first channel, so either a triple interaction with the R&D or investment. Column 5 and 6 are showing you the interaction, whether the brown firm is young or not. And the final 2 columns are showing you whether the firm is or is not the SBTI signatory. Across the sample, you don't really see much. The results are either statistically insignificant or they're actually going the wrong direction. So overall, we don't find any evidence that these high environmental reporters are actually trying to fund the transition towards greener technologies. Now, in the paper, we further look into additional margins. So as I already mentioned, we don't really see that these banks would be scaling down the amount of credit, but there can be potentially affecting other loan contractual firms. So in the result right here, you see the results when we focus on the interest rates. And the idea here is that maybe they are charging them higher interest rates on these loans. And you don't see that that's not what's going on. Again, the results are statistically insignificant, and if anything, they're potentially even going the wrong direction. The other potential contractual margin is the maturity. So you might be thinking that these banks are forcing these polluting firms to shorter maturity loans, so to face higher rollover risk as the time develops. Again, not much to see there. One of the coefficients, the one in column 3, is actually again going the other direction, but overall we can say that the contractual terms doesn't seem to differ when you think about the bank that pays a lot of attention to the environment versus the one that doesn't. So the final result I want to leave you with is looking into the role of relationship lending. In the column 1 and 2, we're proxying for a relationship lending with the exposure, where exposure is essentially the share of the credit I as a firm get from bank 1 as a share of my total bank credit. And what you can see here is that high environmental reporters especially lend more to brown borrowers if they have already extended them a large share of credit in past. So they have a strong relationship with these firms, and they might be reluctant to discontinue such relationship. Now, in light of this result, we'll look deeper into a potential channel that can be related to this opacity, specifically to the zombie lending. There's a lot of literature, especially in Europe, showing that undercapitalized banks might be more likely to lend to unprofitable borrowers. So we proxy for this low profitability or low health of the borrowers with 3 different measures that are standard in the literature. Whether the firm has low or negative ROA, a low sales to employee ratio, or low interest coverage ratio. And you can see the triple interaction coefficient highlighted in orange. And out of the 6 specifications here, 4 are positive and statistically significant, suggesting that these discrepancies between the actual lending behavior and the bank environmental descriptions are actually more pronounced for lending to firms that are of poor health. And linking this to the zombie lending, there's essentially an additional layer on the zombie lending. So what you normally know in the literature is that banks might be reluctant to terminate the zombie lending because this would force them to recognize credit losses. Now, recall when I started talking about the ANA-credit, I told you that this is a confidential data set that we cannot really observe as market participants or investors. So we don't really see what banks are doing in their loan books. We just trust what the banks say in their disclosure. So by actually recognizing those credit losses, if worse comes to worse, the bank would not only need to talk about the credit losses, but they would also need to discuss and explain their exposure to these brown industries. So in other words, the banks might have another layer of the reluctancy to terminate the relationship with these types of unhealthy zombie firms. And finally, moving to the bank level heterogeneity, I'm going to start with looking into the heterogeneity based on the capitalization of the bank. And what you can see here is that the high environmentally reporting banks are more likely to lend to brown industries, especially if they are lowly capitalized. And again, this brings me back to this zombie lending channel, because we know from the existing literature that undercapitalized banks have particularly strong incentive to hide their losses and continue lending to these unprofitable firms. Secondly, we also see that this relationship is the strongest for large banks, which can be related to the fact that large banks in particular face more institutional pressures to integrate climate goals in their strategy, and as a result they may overemphasize their stewardship to their investors about this green lending. So in other words, we see that this credibility can be very hardly observable to market participants. In terms of hard observability of this lending, you can see in columns 3 to 5 additional heterogeneities as to whether the bank is using mandatory sustainability reporting, whether there's any change post-Paris Agreement, and whether these sustainability reports are third-party audited. And you don't really see much in any of the three proxies, which again is to suggest that these environmental disclosures are very hard to compare and standardize, and the result, they cannot be easily regulated or verified by the external auditors. So to sum up, in this paper we show that banks that stress environment more in their disclosures actually end up lending more to high-emission borrowers. We don't find any effect that this should be helping the transition towards greener technologies, and instead we documented the close relationship between banks and firms matters, and specifically the lending towards zombie firms than to hinder the transition of the banks towards more responsible green lending. Thank you.
Okay, well, thank you very much. Okay, and the discussant is Ortega from the Banco de España.
Thank you very much for having me here discussing this fantastic paper. While reading it, it was a pleasure to read, by the way, very well written. And while reading it, I was like, I think, raising my eyebrows as I could see in the public while she was going through more and more results and robustness analysis on the results. So I wanted first to congratulate the authors. It's really well written and easy to read. I find it's a very necessary paper to put some evidence and numbers into the greenwashing debates and also into the value of the actual information reported by banks and how much they are valuable to infer their lending policies. In a nutshell, it explores whether the euro area banks claim, whether the bank's claims of sustainability performance are reflected in actual greener lending policies, or if just they aim to greenwash their loan portfolios by selectively disclosing positive environmental information of their activities. It's actually a very well thought and carefully conducted contribution. Basically, all the robustness analysis extra that came to my mind were actually done in footnotes or appendixes. And my main point is this paper leaves somewhat worried. The central banker, maybe naively, believes that there's a key role for the financial sector in actually guiding the green transition through financing green investments. So let me a bit zoom out and come back to what's the main ideas of this, the role of the financial sector in guiding the green transition. I'll use 2 slides on that, and then I'll go into commenting some of the results. So the first one is obviously the green transition is basically in the hands of governments, of course. These are the ones who have the main policies. They can increase taxation, help the vulnerable sectors of the society, set the standards, provide agents with certainty, a stable environment. But the financial sector is actually a key player. Actually, this chart is from a special chapter that we published last year in our annual report of Banco de España on the impact of climate change into the Spanish economy. So the financial sector has this key role of efficiently channeling the enormous amount of investments that are needed to actually conduct the green transition. But they have not only to channel these funds, but also to do so while assessing the risks, the exposure of the agents and themselves to climate risks. Of course, central banks have a role here, and that's why this paper is important here. Not only we've been incorporating climate considerations in the monetary policy operation framework, but more importantly, we have the role to monitor the risk of the financial stability posed by climate change and in the green transition, and to enhance the regulation and the prudential supervision. But all this green transition and the workings of these 3 key actors happen in a context of huge uncertainty, a need of international coordination. But the third point, the third dark blue box here, it happens in a context in which it's essential to increase the quantity, quality, and harmonization of environmental information, and that's where this paper appears here. If we want to dig a bit into a general picture of the loan, say the carbon footprint of the loans extended by credit institutions, here you have on the left-hand side the chart for Spain. So the brown line is the total greenhouse gas emissions in the Spanish economy per unit of output, so the carbon footprint of carbon intensity of the whole Spanish economy. Since 2008, of course, it has a downward trend. And in blue, you have the calculation of the carbon intensity of the loans extended by the Spanish financial institutions. So actually, so this is taking the emissions per industry and then weighting them according to the weight of the industry in the total loan portfolio of the Spanish institutions year by year. So you can see the blue line lies above the economy, so maybe the carbon footprint of the loan portfolio in Spain is higher than the overall Spanish economy, but it has fallen significantly, especially since the Paris Agreement. So does it mean that the loans are getting greener? No. So there's some shifting into more green, a higher weight of the green industries. As you can see in the right-hand side, this is a much simpler classification than the paper that we have just heard. This is just above the median or below the median, the industries, according to their emissions per unit of value added. And the percentage of green industries in the loan portfolio of the Spanish financial institutions has increased a bit, but hasn't intensified dramatically in the last years, contrary to what the information of the disclosures show. So this basically is the case of Spain, for Spain, that is in coherence with the aggregate results that Martina just presented. So what this paper is about is that the decarbonization trend in the bank's loan portfolio doesn't match the glossy green picture portrayed by the sharp increase in the disclosures of the environmental disclosures by European banks. And these, on the left-hand side, you have the chart of this indicator, this proxy of environmental disclosure showed by Martina. There's other ways of reporting this increase on disclosures, environmental disclosures. And on the right-hand side, you have some results of colleagues from Banco de España that they show in the Pillar 3 reports of European banks supervised by the ECB, whether they actually have, what's the percentage of institutions that have mentions regarding ESG frameworks or ESG risks. And you see that from 2019 to 2020, there was a sharp increase just in 1 year. And it was especially the case for smaller institutions, but it's all over the place. So this is coherent with this increase that Martina showed. The main results, she was quite efficient in telling us the main results, and basically that Euro area banks with higher environmental theme disclosures lend significantly more credit to brown industries. This is the first main result. And this is tested with a very welcome extension to firm level data, which I encourage you to dig further, because it basically concentrates into big firms, and it would be very nice to see a bit more. And they lend significantly more credit to brown industries, and there's some result that she didn't highlight, and I found a bit puzzling. Banks reporting, the high environmental reporting banks, 1 year, they tend to lend more to brown industries even 3 years ahead. So kind of forward-looking greenwashing. And in my head, it makes sense to declare more environmental concern and then act later. But 3 years later, I'm not sure that this makes much sense. This long forward-looking greenwashing. And this, as you show, this higher credit is not for the green transition through R&D investments or to discourage brown activities through higher rates or shorter maturities. These banks do not lend significantly more to green industries, and they are less likely to discontinue established green credit relationship with brown borrowers. So this case of banks with low capitalization that report more environmental disclosures, they lend more to brown borrowers, but especially bad brown borrowers. I found a bit, this is an argument that applies to everything. Why are more prone to zombie lending the high environmental reporters than other banks. It was unclear to me. My final point is, all right, if environmental disclosures by European banks in this period, 2014-2020, cannot be trusted as reflecting lending policies that support the green transition, is there not hope for this call I made in my first slide that it is essential to increase the quantity, quality, and harmonization of environmental information? Well, she showed a table in which even the countries where there's more audited sustainability reports, it doesn't make any difference, and also other measures that have been taken. So my question here is, what would the authors think that regulators and prudential supervisors of the banking system can do about environmental disclosures if what has been tested so far doesn't seem to work? With this, I finish. I thank you for the paper, and it leaves me a bit worried, but I think it's a very nice paper, and it contributes greatly to the greenwashing debate. Thank you.
Okay, thank you, Eva, very much. So, back to you, 2 minutes.
Perfect. Thank you very much, Eva, for a fantastic discussion. So I'm going to very quickly jump onto a couple of things. Yeah, I agree. The firm level data are incredibly promising, and I think we could be doing more there. The problem is we're losing a huge amount of firms, so there is a trade-off. We now have more results into actually tracking these emissions over time to see whether they fall. Spoiler, they don't. So they seem to be that there's, again, like no transition evidence, even looking more into the firm level emissions. On the forward-looking greenwashing, so yes, we have included now more results by actually using different leads and lags for the environmental disclosures. So essentially the main message here is that these environmental disclosures seem to be mostly time invariant. So a bank is either the type of a bank that likes to talk more about the environment, or it's a bank that just does not talk about these topics. And it doesn't seem to vary so much year from year. So as a result, when you implement some of the lags, you see that this result kind of remains there over time. Coming to the zombie lending, I think it really suggests that the talk is cheap, and if a bank is undercapitalized, there's really no problem for the bank to hide these losses and distract, from the loan book towards other activities of the bank that could potentially, again, as I showed early on, is benefiting, their ESG rating, that there are other positive facts. So that the undercapitalized bank that's engaged in these types of, lending behavior might essentially prefer to distract the attention and make more focus on other parts of their activities. And then finally, on the big question, is there any hope for the regulator and how should we think about this? I think that's a very hard question, and I think it opens the debate. I'm going to say two things. One is on the side of the regulator. So we were able to write this paper using ECB data, which are using the $25,000 euro threshold. My understanding is that Bank of Spain has even more granular loan-level credit registry data. So again, like regulators can learn more than compared to what the market participants can see. So there is some scope to, have better understanding in terms of the supervision, like what kind of loans banks are actually making. And the second comment is related to the standardization of these disclosures. So right now, banks can really say whatever they want in their reports, and they're not really penalized for saying anything. Right now, there's a case playing out in the French courts when the non-profit firms are suing ING for saying something about being environmentally friendly. And the case is playing out now in the court, so it's going to be interesting to see whether ING will be forced to pay the fines. And if so, this can have a market disciplining effect of its own through the legal system. Yeah, I'm going to stop there.
Okay, well, thank you. You wanted to? Okay, you go first.
So, I agree very much, first of all, with Eva, great paper, so very interesting. One suggestion, one remark, so you're using Orbis data already, so it might be interesting. Orbis has this banker variable, so it shows you publicly known bank firm relationships, and then you have a couple of that are in the light and a couple of that are in the shadow, so you might use this to distinguish, see what banks are doing for both type of firms. The second, the remark, I think your implication go beyond zombie lending. So if you are even lending to a viable Brown firm, and you are the relationship bank, you might be very reluctant to stop this relationship if you have a large exposure to this firm, because first of all, there's adverse selection, like if other banks see that you as a relationship bank cut back on lending. On top, this is a Brown firm, you might be very scared that this viable firm turns to a non-viable firm because you as a relationship bank cut back lending. So I think that goes even beyond just zombie firms.
Let's, okay, Solly. Second row.
Well, thank you very much for your paper. I think it's very good, although it's really pessimistic and it's bad news. But I don't know, I mean, we all know that big banks, which are the ones that disclose more, are very intensive brown lenders. By a matter of fact, the stress test that the ECB did, they found that 2/3 of the income coming from non-financial firms are coming from brown firms. No? So that's on the picture itself is not so surprising as you think. I know that you control by time, but I would like to see, I mean, or probably you have done it, if it is really increasing, which will be the problem. I mean, have you plot the percentage of brown lending over total lending? Because, I mean, your period is 2014 to 2020, which especially the first years were not, I mean, nobody was worried about these things, especially 14, 15 probably. And also something that may explain that is precisely because these high intensive in brown lending banks are managing risks, climate related risks. For instance, if they are issuers of green bonds, maybe they are just issuing green bonds and then they are doing green lending too with the funds raised from the green bond issuance, and then compensating the risk coming from brown lending.
Xavier.
Thank you. Very illuminating paper. In relation to your last comment, what you were saying at the end, you did not say much about the type of disclosures of the banks. And I think there, could it be that generic disclosures are associated to what you say, but then that institutions that have much more precise disclosures with a scope 1, 2, 3, whatever, no? And they are much better targeted than it's the opposite? Then could it be, because this I think could be the, in a sense, the good news, and also the way that regulators should go, no?
Okay. Veronica. Okay, well, come on, sí, venga.
What are your expectations on the effects of these more standardized, extensive disclosures? Can they be potent enough to induce somewhat negative supply shock on brown firms, some substitution towards financing towards NBFI or banks that have some exemptions of these disclosures, or this is too potent? Can this affect the communication strategies of banks? Will they try to differentiate, or it might lead to some content to conform to the standard and reduce this heterogeneity? Thanks.
Okay. And now, Veronica, your turn.
Thanks. This was a great paper. I have just one comment. I see your paper as a huge criticism for a lot of recent research on using text-based analysis on how we measure variables. This is a text-based variables are great. We have many of them, but what you're saying is that in the signal-noise ratio, maybe there's a lot of noise, and the noise is not the classic white measurement error. It's an error that is driven by demand and supply components that probably are really bad for any identified study. So it's really a comment more than a question, but I think there's a lot of criticism in using that type of measurement after your paper.
Okay. Right, so let's, Javier, and yeah, and
So
then
very quickly,
the last
I
one.
think I'm going to go on things that have been said, but just to reinforce the message. I see this paper as a call for caution against the meaning of soft disclosures. It's in line with what Veronica and Xavier were saying, soft as opposed to hard disclosures, no? And your references to the disconnect brought to me immediately to think about a Spanish proverb whose translation to English is, they brag most who can do the least. Dime de qué presumes y te diré de qué careces. So I think these firms, I mean, these banks feel guilty by how much brown they have, and then they talk about green in the discursive part of the disclosures, but they cannot report hard numbers supporting their claims. So I think the regulators will have to go towards the hard information. Another comment, leads and lags. I think your discussion was very good, because I think this will make me more convinced about what is the direction of causality. From my proverb, basically, is you have a lot of brown and then you do this type of cheap talking. But it will be nice to find what comes first, whether the big brown portfolios and then the references to green, or the other way around. It will be very strange that you increase your intensity of disclosure and then you go into further brown, but maybe that happens and then it will be really anomalous.
Javier,
Okay, I passed it.
Tamon.
Hi, Martina. So I have one additional comment since last week. We discussed the paper together. So I was wondering if you could add a little bit more color on how non-high environmental reporters are doing in terms of their performance for greening their loan portfolio. Are they doing super good and high environmental reporters are doing bad? In this extreme case, the greenwashing argument is a very strong argument. The other extreme is every bank is doing bad and high environmental reporters are doing even worse. In this case, probably the regulatory constraints or the possibility of firms doing greenwashing or simply technologies lagging behind, these may be responsible for the result that you see. So I was wondering which is closer to the reality. Thanks.
Okay, finally, Sole wants to have a very short remark here in the, hey, can you bring it here to the second row on the left?
Yeah, just a very short question. Do you think that things will change with the new regulation on disclosure? I mean, the directive, they will have to precisely report on the percentage given to brown industries or to green industries, whatever, and also about scope 3 emissions. So scope 3 emissions will cover that. I mean, will cover which is the effect of the lending on emissions. So would you think that it will change? I mean, they will have less room for greenwashing, but.
Okay, well, thank you. You have quite a few questions in very little time, but let's see what you can manage.
My response is standing between you and the lunch, so I try to be extremely quick and we can talk more afterwards. So yes, we can definitely use more Orbis. I like the idea. And yeah, I think we can do more with this data. The data is ready, so I fully take your comments, and I think we can definitely do that. In terms of the overall lending dynamics, we do aggregate the results on the bank loan portfolio, and we indeed do see that these high environmental reporters are shifting their portfolio towards more brown. So this is not just the loan level information, there is actually more brown lending also in total. We also split the results by years. So we first dropped the very beginning of the sample, then we estimated year by year, but then we also drop the very last part of the sample. It doesn't really matter how you slice the data. The result is always there. Magnitudes might slightly differ. If anything, the results are getting stronger these days. But again, that's primarily driven by the fact that we have better data and banks like to talk about this more. Again, coming back to the discussion that this talk is generally cheap and there doesn't seem to be much punishment for it. In terms of the discussion we had here on other activities, so I think that the issuance of green bonds and other activities that banks are doing that are green are kind of, on one hand, compensating for the activities that are happening on the loan book, but more importantly is, as I mentioned, the loan book is unobservable for investors. So banks can choose to selectively talk about these, like positive things that can be verified because you can see green issuances, but as you cannot really observe the loan book, there's a little bit more of a dark area. Xavier, on your questions, yes, we played a lot with the disclosures. We excluded information such as whether the banks talk a lot about like very far future, by 2050 we want to do something. We played a lot about dropping information that are just general environment. Sometimes banks just talk about like fires or they talk about droughts as an overall problem. We also use the measure of the sentiment, so to kind of measure more the vocabulary around these words, whether they pursue these things as risks. Again, our results are generally robust to all of these additional tests. This brings me to Veronica's comment on the disclosures. Yeah, the signal to noise, again, coming back to the point that the talk is cheap and at this stage is not punishable, so it kind of doesn't really matter how state-of-the-art measurement textual analysis you're gonna implement. There still appears to be a disconnect as to what banks say and what they actually do in their loan books, which we find particularly worrying. In terms of the communication, yes, there is a large heterogeneity at this stage. So we do see some banks that talk about it a lot, some banks that don't. It would be interesting to see over time what happens, whether there's more homogeneity, again, coming to the fact that there doesn't seem to be much, repercussions. There is a big question is like, why don't all banks do this, given that it doesn't seem to be a problem? And I agree, we can try to do more there. I love the call for caution on soft disclosures. Javier, I think it's a very nice summary of the paper. The leads and lags, yes, I misspoke. For now, we use the lags, different lags, but we haven't tried the leads, and I agree. We use the other one. So we look to the future. We haven't tried looking to the back, and I think we should, because that could help us more with the causality, as you exactly pointed out to. So that's definitely on our to-do list. And then, what about the regulation? If we have better disclosures, I guess we all have to see. There is some mixed evidence. I mean, we know that there are papers looking into, say, stress tests and how banks can still manage to hide their losses. So it probably matters on the sophistication of the banks. But I agree that more information should definitely shed more light and potentially improve the bank discipline. And in addition, scope 3, again, it's a great idea to measure it. The problem then becomes how much of these firm level emissions are actually firm really based and how much are model based. So again, there is some heterogeneity in like what's the quality of the information we're getting from these types of sources. I'm going to stop there and happy to talk more offline.
Okay, well, thank you very much. It was a great session. Thanks to the speakers and the discussants.